Welcome to Capital Allocation LabCom, audio first lessons that turn classic investing ideas into practical decisions for today. If you value timeless business analysis over hype, you're absolutely in the right place.
Yeah, our mission here is really centered on helping you, the long-term, fundamentals-minded investor, build robust judgment, the kind that withstands market volatility.
Exactly. And if these deep dive lessons help you, please subscribe and tap like it genuinely tells us to keep making more educational episodes just like this one.
So today we're doing something a little different. We're focusing entirely on defense.
That's right. We're detailing the enterprising investor's no list. Think of it as a walkthrough of what a serious, hands-on investor should typically, avoid.
It's what we call the negative approach, and honestly, we see it as maybe the most critical first step. These are the guardrails, the fences you build around your capital.
Protecting what you have before you even start searching for the next big opportunity. Build a perimeter fence first.
Sure.
Okay, so maybe let's start by setting the context. Who exactly is this enterprising investor? Because it doesn't mean thrill-seeking, does it?
No, absolutely not. That's a common misconception. It doesn't mean speculator or someone chasing high-risk ventures.
Right. So when we use that term, what we're really describing is someone who's willing to, do more work than maybe the average passive investor.
Exactly. Someone who's dedicated enough to actually read the annual filings, to normalize earnings so you understand the true economic performance through a full cycle, not just the good years.
And really digging into the incentives behind who's selling the security. That seems crucial.
It is. Evaluating those incentives and, importantly, committing to maintaining a clear, written investment policy. You have to write it down.
So the edge here isn't some kind of secret forecast or being smarter than Wall Street.
Not at all. It's derived entirely from your commitment to effort, patience, and process. It's that rigorous approach that allows for better decision-making, especially at the margins.
And it's important to stress, even with all that extra effort, the starting point is still the same sensible base, isn't it?
Absolutely. You start from a durable, high-quality core portfolio. A sensible split between high-quality bonds and high-quality equities, and crucially, purchased at reasonable prices. That foundation doesn't change.
So the enterprising part is really about what happens outside that core.
That's it. It's the extra analysis you apply,
Right.
which drives better selectivity. And maybe most importantly for today's discussion, it's the unwavering discipline to say no. Especially when you see an investment product that seems designed with, let's say, structural asymmetries.
Meaning designed to benefit the seller more than the buyer.
Precisely, when the design favors the seller at your expense.
Okay, so this whole deep dive is about what to leave alone. And you mentioned earlier, this is where it gets really interesting. The idea that most permanent losses, they don't come from just market swings.
That's a key insight, yeah. They often stem from these structural disadvantages baked into certain types of securities.
Securities created when the seller's incentives are the top priority.
Exactly. That optimization for the seller often results in structures designed maybe to hide risks through complexity or, products offering yields that look tempting.
But don't really compensate you for the actual risk.
Right. Poor compensation for the underlying risk of default or dilution down the line. And very often, these come wrapped in compelling marketing stories.
Stories sold because they're easy to understand, easier than the messy underlying economics anyway.
Much easier. The narrative sells better than the sober analysis.
So tracing it back, it really boils down to misaligned incentives.
That's the root of it. So the goal of this whole defensive process, this no list, is simple: alignment.
You look at the security structure, the tax treatment, the pitch.
And you ask, does this align better with the seller, the one offloading the risk, or with me, the buyer? If it's the seller, the rule is just pass.
That discipline, sticking to that over the long haul, sounds like the best tool for capital preservation.
It truly is. Maintained over decades, it's incredibly powerful.
Okay, let's get concrete then. What's the first major category on this no list? Where do individuals often run into trouble?
A big one is high-grade preferred stock.
Yeah, I can see the appeal, especially for income investors, right? It sounds safe, high grade, and it offers a fixed yield. Often looks quite attractive on the surface.
It does look tempting, but the structure, when you dig in, tells a very different story about who it's really optimized for.
Okay, so who is it optimized for?
The reality is, this instrument is usually optimized for corporate holders, and the main reason comes down to the tax code.
Taxes. Okay, how does that work?
Well, in many places, corporate buyers get a significant dividend exclusion. That means only a fraction, sometimes none, of the dividend income they receive from preferred stock is subject to corporate tax.
Right. And for an individual investor, that dividend income is just taxed at their regular rate, correct? There's no special exclusion.
Generally, no. So think about the math. A preferred stock pays, let's say, a 5% dividend. For a high-tax corporate entity getting that exclusion, that 5% might feel like the after-tax equivalent of a much higher-yielding bond, maybe 6.5% or 7%, where they'd pay full tax on the coupon.
Wow. Okay, so that tax break completely changes the relative value for a corporation versus an individual.
It's a massive difference. And it fundamentally shifts the true economic value proposition away from the individual investor just looking at that headline yield.
And that's even before we talk about other terms like call features.
Exactly. Those corporate buyers, they can usually tolerate the common call features that cap your upside.
Yeah.
They aren't really looking for equity-like capital gains. They're focused on that tax-advantaged fixed income stream.
So if you're an individual comparing, say, a high-grade preferred stock to a high-grade bond from the same issuer.
The bond almost always dominates for the individual. First, the bond gives you superior priority in the capital structure. If things go wrong, bondholders get paid before preferred stockholders.
Better recovery potential in distress.
Right. And crucially, bonds usually offer better call protection. That means the issuer can't just decide to redeem the bond right when interest rates fall and your fixed income asset becomes most valuable to you. Preferreds often lack that strong protection.
So the individual gets less protection, worse tax treatment. It sounds like you really need to sharpen your pencil.
You absolutely do. You must meticulously compare the after-tax yields, factoring in your personal tax situation, and you need to understand exactly what the call terms are and if you're comfortable with that risk.
And if there isn't a really clear, obvious after-tax advantage and you haven't consciously accepted that call risk.
Then the prudent rule is let corporates own this lane. Just stick with plain, high-quality bonds. If a preferred is genuinely a unique bargain for an individual, the terms will likely be so generous it'll be obvious without needing a slick sales pitch.
Okay, that makes sense. Let's move to the next guardrail. This one feels like a classic behavioral trap, reaching for yield. We're talking second-grade bonds and lower quality preferreds.
Yes, the siren song of those extra percentage points of yield. It lures so many investors onto the rocks.
Because that extra yield isn't free money, is it?
Far from it. It's often illusory. It's supposed to be compensation for inherent risks. The risk of default, the risk the issuer might defer paying the coupon, dilution risk if the company gets into trouble and has to swap debt for equity.
Or just call risk, where they redeem it early if it works out for them.
Exactly. Any one of those risks can easily consume the entire yield benefit you thought you were getting, and you can end up losing principal.
I can hear some listeners thinking, though, but what about when high-grade bonds yield almost nothing, maybe less than inflation? That's when the pressure to reach feels strongest, right? It feels almost necessary.
It does, and that's the perpetual challenge for the enterprising investor, maintaining discipline when everyone else is finding reasons to compromise. But the rule here has to be firm. The only sensible way to even consider this category is as a distressed bargain, offering multiple, provable ways to win. And that requires a really high discipline threshold. You're not looking for a little extra yield. You're demanding deep, not cosmetic, discounts to par value.
So we're talking about situations where a bond is trading significantly below par because the market is genuinely worried, reflecting real distress.
Yes. And then the enterprising investor has to use their analytical edge. You have to rigorously underwrite both the going concern scenario, what happens if the company survives, and the worst-case recovery path if it doesn't, using deeply conservative assumptions.
And this isn't just about the numbers, right? You mentioned covenants earlier.
Covenants are critical here. The real danger is buying something yielding just a little extra when it's trading near full price but comes with weak covenants.
Weak protections for the bondholder?
Exactly. Weak covenants give the issuer too much flexibility maybe to issue more debt ahead of yours, sell key assets, or restructure in a way that benefits management or shareholders over you, the bondholder.
And that structural weakness. That's how you lose slowly, then suddenly very quickly when a downturn hits.
That's the classic phrase, isn't it? Lose slowly until you lose quickly. The slightly higher yield just doesn't compensate for that risk of major principal impairment if the covenants don't protect you.
We also need to think cyclically here, too.
Absolutely. When first-rate high-quality bonds are already offering fair, decent yields, which does happen, the hurdle for buying anything lower grade should be almost impossibly high. Why take the extra risk?
So the key takeaway, No full-price compromises in lower-quality debt. If the math doesn't scream bargain after very sober conservative analysis of the downside,
You just pass. Period.
yeah.
All right, let's turn to guardrail number 3, foreign government bonds.
Ah, okay. These often pop up on investors' radar because they can offer yields that look really high compared to, say, U.S. Treasuries or German bonds.
They certainly can dangle those attractive yields, but those yields come packaged with significant risks the individual investor often can't easily price or manage.
What kind of risks are we talking about here primarily?
You're layering on, often simultaneously, significant currency risk, the value of your investment fluctuating just based on exchange rates. Then there's policy risk from a government whose decisions you might not understand or anticipate, and of course political risk, the fundamental risk regarding the government's ability and, crucially, willingness to actually pay its debts.
So, taking on risk you can't really price. That sounds less like investing and more like,
Speculation. If you don't have genuine local insight, specific expertise in that country's politics and economy, and trusted legal protections, you can rely on if a crisis hits. It's speculation, not a process advantage.
and individuals can't easily diversify away those kinds of macro risks or hedge the currency exposure effectively like a big institution could.
Exactly. It's a scale game, and it requires sophisticated tools. So for the vast majority of long-term individual investors, this lane is really better left to large institutions.
The ones with the global reach, the mandate, the scale, the hedging capabilities.
Precisely. Unless you possess a very specific, highly defendable edge, maybe you live there, you have deep professional expertise in that specific country. The advice is usually to skip foreign sovereign bonds as a core holding.
Simplicity is protection, again.
It often is.
Okay, simplicity, or the lack thereof. That seems like a good transition to guardrail number 4. Convertibles and sweeteners. These hybrid securities that mix debt and equity features.
Yes, things like bonds that can be converted into stock or bonds issued with warrants attached, giving you the right to buy stock later.
Why should we be wary of these?
Well, often these complex structures are issued precisely because the company couldn't raise money easily with just plain straight debt. Maybe their credit quality wasn't strong enough, or the interest rate would have been too high.
So the equity sweetener, the conversion option, or the warrant is added to make the deal palatable, to lower the issuer's cost of capital.
Exactly. It helps the issuer.
Yeah.
Which often means the buyer is effectively overpaying for the total package, because the complexity is designed to benefit the seller.
So how do we cut through that complexity? How do we apply discipline here? Valuation seems tricky.
The only way is to apply practical test. You have to mentally break this security into its component parts.
Okay, so part 1.
Part 1. What is the bond floor worth on its own? Treat it like a regular bond from that same issuer. And crucially, use the issuer's real credit quality, which might be weaker than you think precisely because they needed the sweetener in the first place. Don't get seduced by the equity potential when valuing the debt part.
And part 2 is the option piece, the conversion feature or the warrant.
Right. What is that option worth? And you must value it using sober volatility assumptions, not the wildly optimistic ones often used in marketing materials.
And the test is, if your analysis shows you wouldn't buy the straight bond part at that implied price, and you wouldn't buy a clean, transparent option at the implied price, then the bundle isn't a bargain. It's just marketing trying to sell you two potentially subpar assets packaged together.
That makes sense. And I seem to recall complexity often gets worse with these due to call features. Oh, absolutely. That creates a really painful asymmetry for the buyer. The issuer often retains the right to force you to convert your bond into equity, or they can just call the whole security away from you.
Right when the equity part starts doing well and things are finally moving in your favor.
Precisely. They cap your upside just as it gets interesting. It's a classic misaligned incentive. The simple rule here is, if you cannot explain clearly in maybe one paragraph how you win with this security, and just as importantly, how you might lose,
Don't buy it.
don't buy it. If it's too complex to explain simply, it's too complex to own.
Okay, this leads us to guardrail number 5. And this one, I suspect, is behaviorally the toughest, being wary of new issues of pretty much every kind.
It is tough because the excitement can be contagious. But yes, this is a central, almost non-negotiable principle for the enterprising investor. It's not saying all new businesses are bad.
It's about the timing and the process of how they come to market.
Exactly. New issues as a class suffer from two major structural problems. First, they arrive accompanied by salesmanship at maximum volume. intense marketing, road shows, media hype.
Full blast, yeah. And second?
Second, they almost invariably cluster in seller-friendly markets.
Mm-hmm.
They come out when general market enthusiasm is high, and therefore pricing is high.
That makes perfect sense. When the market's hot and stories are easy to sell, that's when it's cheapest for companies to raise capital.
Right, which means, conversely, the price is richest or most expensive for the buyers, for you.
It's the complete opposite of rationally buying something when it's on sale. You're buying when prices are highest.
Precisely. You're buying capital at retail, maybe even premium retail, not wholesale. So the only defense against this structural disadvantage is to apply an unusually severe test to any new issue.
Okay, what does that severe test look like?
Well, first, you demand a long record of audited economics, not just a story about exciting revenue growth. You need to see profits, margins, cash flows, preferably through different economic conditions.
You have to normalize those numbers too, right? Look at margins and capital intensity across cycles, not just the recent peak.
Absolutely critical. Normalize everything. And then when you get to valuation, use conservative multiples and apply them to your estimate of mid-cycle profits, not the potentially inflated peak profits they just reported.
And always compare. Compare the business being offered now in this hyped-up IPO.
To what is already available on the public market. Seasoned companies, maybe with longer track records, potentially trading at better terms, without all the sales pressure.
It's like avoiding the frenzy of a garage sale on day one and waiting for the calmer estate sale later.
That's a great analogy. You must assume seller advantage is baked in until proven otherwise, rigorously. If that very high bar isn't clearly cleared with transparent, normalized economics and a sober valuation.
Just say no thank you.
Exactly. Pass.
Let's drill down specifically on IPO's initial public offerings and maybe secondary offerings of common stock, too. The excitement factor here seems particularly dangerous, those first-day pops everyone talks about.
They are dangerous for the average investor. Those initial fireworks, that big jump on day one, disproportionately benefit the insiders and the institutions who got the initial allocation at the IPO price.
Before it even starts trading publicly.
Right. Everyone else, the individual investor, like you perhaps, who buys after trading, begins on the open market. You're paying the price after the pop.
And history shows that often leads to less than stellar returns.
Often, yes. It frequently leads to years of subpar returns as that initial, sometimes manufactured optimism deflates and the shares eventually just blend into the regular market float, subject to normal valuation pressures.
So if you're like most of our listeners and you're not getting that initial pre-IPO allocation,
then your base case assumption should probably be underperformance, at least for the first few years, not instant riches. The much calmer, more professional approach is simply to wait.
let the dust settle, let the company operate as a public entity for a while, build a track record under public scrutiny.
Yes. Let it season. And then, maybe a year or two later, you have the fundamental question that always matters. At this current market price, looking at its normalized economics, now that we have more data, is the owner's yield attractive?
That forces you to make a decision based on value, not hype or the fear of missing out.
Precisely. And it forces you to make that critical distinction. Don't confuse a great product or a cool company with a good stock if the price is too high. The best businesses are often overpriced, especially when they're new and exciting.
So the behavioral lesson is crystal clear. Resist the fear of missing out, FOMO. Investing is a marathon, right? Not a launch day sprint.
Absolutely. Discipline in avoiding the IPO frenzy is key to long-term compounding. Open page. Okay, so we've identified these danger zones. To make this really practical, let's talk about specific behavioral cues, almost like warning signs.
Yeah.
How can you smell seller advantage, maybe even before you open the prospectus?
Yeah, quick tells. What should we look for?
All right, here are 3 quick ones that often signal misdirection. First, complexity marketed as innovation. If the pitch focuses heavily on the fancy structure of the security or how novel the idea is, rather than on plain, understandable, observable cash flows and normalized earnings, be very wary. Complexity often hides risk.
Okay, complexity as a red flag. What's number 2?
Second, watch the promised yield. If it's, just high enough to tempt you away from safer, high-quality alternatives, but there's no clear fundamental reason why it's that high compared to similarly rated things. That extra yield is probably payment for an unstated or opaque risk.
An unpriced risk premium. Got it.
And the third quick tell.
Third is narrative urgency. Any language that pushes FOMO limited window. Get in early. This is the next Amazon. Good. Sound securities trading at fair or bargain prices don't need that kind of high-pressure sales tactic. Their value speaks for itself.
Makes sense. Good deals don't need hype. Are there others?
Yeah, two more critical ones. Fourth, look closely for asymmetric call and covenant terms. Clauses where you, the buyer, give up most of the potential upside, like through an early call feature, while the issuer keeps maximum flexibility to operate, issue more debt, or change things to their advantage. That asymmetry is a huge red flag.
Skewed in the seller's favor. And number 5.
Fifth, watch for a flood of lookalikes. When suddenly everyone seems to be issuing the same type of product, think ways of SPACs, or new private credit funds all launching at once, or complex structured notes all promising the same thing, that's usually a sign of peak issuer advantage. Sellers are rushing to market while demand is hot and pricing is favorable to them.
It's a sign the cycle might be peaking for that asset type.
Exactly. Now, if you actually keep a written log, just jot down these tales when you see them, note the opportunities you pass on because of them. You'll build this powerful personal record. You'll see how often saying no felt maybe a bit boring or contrarian in the moment.
But turned out to be absolutely brilliant in hindsight.
Brilliant, or at least capital preserving, which is the whole point.
Okay, that log is a great idea. To make this even more actionable, you mentioned a filter earlier, a way to screen these decisions.
Yes, a simple negative screening filter. We call it S.E.V.E.R, S.E.V.E.R. The idea is it helps you sever bad decisions before they infect your portfolio.
S.E.V.E.R. Okay, walk us through it. What does the S stand for?
S is for salesmanship present. Was this idea pushed on you? Did you find out about it because someone was actively selling it? If yes, you immediately double your skepticism. Truly good bargains rarely need aggressive marketing.
Makes sense. Okay, first E.
The first E is for economics normalized. Can you genuinely, confidently underwrite the free cash flow of this thing through a full economic cycle, including a potential deep recession, not just relying on the good times we might have just had?
So no extrapolating peak results.
Absolutely not. If you're just projecting the recent best-case scenario forward, you're forecasting, maybe even hoping, not investing based on durable economics.
Got it. Next is V.
V is for valuation versus alternatives. At the price being offered, does this security clearly beat other things that are already available? Things that are public, seasoned, maybe less complex. If you can get similar exposure cheaper or simpler elsewhere, why take the extra risk or pay the higher price?
Okay, second E.
The second E is critical. Edge identified. What is your specific, concrete, defendable advantage in analyzing this particular security or situation compared to the professionals who might spend their entire careers on it?
And if you can't clearly state your edge,
If you can't name it in one clear sentence, maybe it's superior patience, maybe deeper analytical insight into this specific niche, maybe a structural reason you have to own it, then you probably don't have an edge. And if you don't have an edge, you should pass.
all right, finally R.
R is for risk of permanent loss. Have you meticulously mapped out the realistic downside scenarios? What could cause you to lose a significant chunk of your capital permanently? Things like dilution, default being called early, currency swings. If the path to potential impairment is fuzzy or complex or hard to quantify,
Then your homework isn't done.
your analysis isn't complete and the risk isn't truly understood. So the process rule with S.E.V.E.R has to be rigid.
If any letter fails the test.
The default decision is pass. Just move on. Your capital is precious and finite. There will always be clearer, plainer opportunities down the road that don't require mental gymnastics to justify. Save your firepower for those.
Okay, S.E.V.E.R, salesmanship, economics, valuation, edge, risk. That's a powerful filter. Let's try to apply this kind of thinking with even more specific checklists for a couple of those tricky areas. First, back to lower grade debt. For those rare times you think you might have found a genuine distressed bargain, is there a rule of thumb?
Yes, for that specific high-risk situation, we use what we call the 30-10-3 rule. It helps enforce the necessary discipline.
30, 10, 3. Okay, what's the 30?
30 means you demand a deep discount to par value. We're talking maybe 30 cents on the dollar, maybe 50, maybe 70. The exact number depends, but it has to be a discount that reflects real structural distress, not just market jitters. You buy only when there is significant measurable pain reflected in the price.
Okay, deep discount. What's the 10?
10 means you must be able, with your analysis, to outline a credible 10-year viability path for the underlying company. And this has to be under sober, even pessimistic assumptions, not relying on heroic turnarounds or rapid growth. Can the core business fundamentally survive and likely service its debts for a decade, even if conditions stay tough?
So a long-term survival check. And the 3?
And 3 means you must clearly identify 3 distinct ways to win, not just hope. These typically are. 1, the high distress coupon continues to be paid. 2, the price of the bond recovers significantly as the market recognizes the company's improved credit condition or survival prospects. And 3, your downside is reasonably bounded by a realistic estimate of the recovery value, even if a bankruptcy or restructuring eventually happens.
3 clear paths to a positive return with downside protection.
Exactly. And the kicker is, if you cannot write down those 3 ways to win in plain, simple language your spouse or a friend could understand.
Then it's too complicated. You own a worry, not a bargain.
Precisely. That complexity itself is a warning sign to avoid it.
Okay, that's a great checklist for distressed debt. Now let's do the same for new equity issues, IPOs, secondary offerings. What are the critical questions we must ask before even thinking about participating?
All right, here are 4 critical questions for IPO discipline.
Question 1.
1, would I buy this exact same business at this exact same multiple if it were already public and just quietly trading without any hype or fanfare? Strip away the story, the excitement. Is the valuation itself compelling based purely on the underlying seasoned economics?
Okay, isolate the valuation from the hype. Question 2.
2, do the insiders, the founders, the early investors seem eager to sell me shares now, especially after what might have been a long run of favorable market conditions? Ask yourself why they want to cash out now. Why not wait for the business to mature further, for the stock to season in the public markets? Their desire to sell now can be informative.
Good point. Consider the seller's motivation. Question 3.
3, what's my realistic holding period? And related to that, can I truly tolerate, say, a 50% drawdown from the IPO or offering price without panicking and changing my fundamental thesis about the business? New issues are often volatile. If you can't stomach that potential volatility, your position size is wrong, or your conviction isn't strong enough for this type of investment.
Know yourself and your risk tolerance before buying. Okay, and the final question, number 4.
And 4, always ask, what's cheaper and simpler that gives me similar exposure or achieves a similar goal in my portfolio? Are there better, more established businesses trading at lower multiples? Are there simpler ways to get exposure to this industry or theme? Always look for the less complex, potentially better-priced alternative.
Because, as you said earlier,
Better a missed rocket than a purchased crater. Boring, disciplined money that avoids blow-ups is the kind that compounds reliably over the long term.
that's such a key point. History really is littered with examples, isn't it? Stocks that were huge hits on day one, massive pops.
Absolute legends on launch day, only to spend the next few years steadily declining, sometimes dramatically, as the initial hype wore off and the actual business result had to stand on their own.
And the investors who benefited most were often the ones who waited.
Often, yes. The investors who were patient, who demanded that real operating history as a public company, who waited for more reasonable valuations to emerge after the initial frenzy, they frequently got access to better businesses at better prices down the road.
And they probably slept a lot better during that waiting period, too.
Definitely less stressful. The core lesson we have to internalize from all this is that spectacle is not a strategy. Your job as an investor isn't collecting exciting IPO souvenirs. It's the steady accumulation of sound decisions over many years.
Okay, so this entire deep dive, we've focused exclusively on the no list, which, as we've really hammered home, needs to be your first and arguably most critical filter.
It absolutely does. Build the defense first.
Now, in our next deep dive, we will flip the coin. We'll cover the positive approach, identifying where the enterprising investor should actually focus their extra time and analytical effort.
Right. That positive list will include things like searching for genuinely undervalued but fundamentally sound businesses, looking for specific workouts or special situations where there's a clear, definable path to value realization, or opportunities to acquire quality businesses at a fair price when market cycles temporarily create fear instead of greed.
But even when we discuss those opportunities, the foundation we build today remains crucial.
Absolutely. The negative approach, this no list, remains your first filter. Always.
Yeah.
You can't have a great offense without starting with a truly great defense.
So, to help everyone listening integrate this defensive mindset immediately, you mentioned a template, something practical people can use.
Yes, a simple template for a one-page policy addendum. Something you can literally write down and commit to.
Okay, how would that look?
Well, first you'd state your base policy. Something like, maintain a balanced core portfolio of high-quality bonds and high-quality equities, purchased at reasonable prices. Your foundation.
Got it. Then add the defense.
Exactly. Next section, negative approach. Here you summarize the avoidance rules we discussed. Avoid high-grade preferreds unless there's a clear individual advantage. Avoid lower-grade debt unless it's a deep, provable distressed bargain meeting the 3103 rule. Avoid foreign sovereign bonds without a specific edge. And demand severe, sober tests for all new issues, convertibles, and complex marketed products.
Spell out the no list clearly. Then what?
Third, outline your process. Commit to using the S.E.V.E.R screen for any non-core idea. Commit to keeping that written decision log we talked about. And state your preference for seasoned securities with transparent cash flows and simple terms.
So codify the tools. And
Finally, behavior. State clearly that your default answer is no when you detect significant complexity, heavy salesmanship, or manufactured urgency. And maybe the most important part, commit to actually reading this policy addendum out loud before making any investment purchase that falls outside your defined core holdings.
that act of reading it aloud forces a pause, forces reflection.
It really does. Put this all on one page, read it regularly, and stick to it. If a new tempting idea can't walk cleanly through this door you've designed, if it fails S.E.V.E.R or violates your negative rules, it simply does not get into your portfolio. End of story.
That's incredibly practical advice.
Well, that brings us to the end of this deep dive. Thanks for listening to Capital Allocation Lab Calm Lessons for Long-Term Investors. Yeah, thank you for joining us. If you found this discussion useful, please like the episode and subscribe. It genuinely helps us keep these deep dives free and focused purely on education.
And we really do want to hear from you. Leave a comment below, let us know your questions, any pushbacks you have on these ideas, and maybe tell us which fundamental investing concept you'd like us to tackle and unpack in a future deep dive.
We read all the comments, and they help shape what we cover next.
Absolutely. So, until next time, be patient, be clear in your thinking, and let the no list protect your capital so the right yes has the chance to compound for you over the long run.